Today's webinar is sponsored by the Foundation of the Wall and Ceiling Industry. I am Anne-Marie Salvatelli, AWCI's Director of Education. Before we start, I'd like to review a few housekeeping items. Should you have a question at any time during today's broadcast, please submit it by using the question box in the GoToWebinar dashboard. And following the presentation, we will have a Q&A, and we're going to make every attempt to get all of the questions answered. And a copy of today's slides will be available in the handouts shortly. And now I'd like to introduce our presenter, Ken Simonson. Ken has been Chief Economist for the Associated General Contractors of America, a leading trade association for the construction industry since 2001. He provides insight into the economy and what it implies for construction and related industry through frequent media interviews, presentations, and the Data Digest, his weekly one-page summary of economic news. And I know that Ken will have that subscription link available in one of his slides.
All right, well, thank you, Anne-Marie, and I hope this is showing my title slide at the moment. It's good to be back with you. What I want to talk about today is what's been going on with construction employment by location, construction spending by project type, and the number one concern that I hear about from many contractors, materials cost and supply chain issues, and then weave it together to provide some generalized forecasts about where we're heading. The first slide, let me know if the slides are not showing. I'm suddenly seeing my own image again, which I know what I look like. I don't need that. But the first slide shows the of construction. Actually, the Bureau of Labor Statistics presents data, and they did this last Friday up through October, on 5 categories of construction firms. I've combined them into residential construction, which comprises their home builders and general contractors who specialize in multifamily, along with specialty trade contractors, such as many of your members, whether they're working on new construction, additions, or renovations. The red line shows general contractors, specialty trade contractors on the non-residential side, and heavy and civil engineering firms. And then the green line is that headline figure you hear about on those first Friday newscasts, total non-farm payroll employment. And you can see that all 3 series just fell off a cliff from February to April of last year. And then construction rebounded much more strongly than the overall economy. Once people who were cooped up at home were able to go out and look at model homes or existing homes to buy, or decided to renovate and add to their homes, and once the general contractors were allowed to continue business at the project sites that have been halted by either government edict or the choice of owners, we saw a big resurgence in employment. Also, contractors made quick use of Paycheck Protection Program. But after June of last year, there was a big divergence. Residential construction employment kept rising at just about the same rate until by December it crossed that black line, meaning that it was above the February 2020 level. And it kept growing right through October of this year. In contrast, non-residential construction employment really stalled for just about a year. It's only in the last 2 months that it's put together back-to-back increases again. And as a result, non-residential construction employment is a much lower recovery percentage from that low point than total non-farm payroll employment. Well, there are big differences by state. We get the state employment figures 2 weeks after the national numbers. So what we have as of now is still just through September. But what that shows is that only 14 states had exceeded that February 2020 employment level, and this is seasonally adjusted. There's a huge range. At the top, you have Idaho with a 9% increase, Utah and South Dakota with an 8% increase over that February 2020 level. And then down at the bottom, you have Louisiana and Wyoming down a whopping 16%, New York down almost 12%, and several other states down by hefty single digits. AGC does a survey each summer on workforce experience and expectations of our member companies. And I should have mentioned at the outset, I know many of you are familiar with AGC. We're the largest national construction other than single-family home building. They belong through a network of 89 chapters that span the country from Alaska to South Florida, out to Puerto Rico, from Maine to San Diego, out to Hawaii. And we have about 6,500 general contractors, and the rest of the membership divided between specialty trade contracting firms and suppliers of equipment, materials, and services. 90% of the firms that were looking for a craft worker, and we do have some construction management firms that don't hire their own craft workers, 89% of the firms that were looking for a craft worker of some type said that one of those positions was hard to fill, probably many of them. In fact, we asked about 21 different crafts, and for every one of them, at least 70% of the firms that were looking to fill one of those positions said it was difficult to fill. Now, on the salaried side, it was almost as bad. We asked about 11 different salaried positions, and of those, the hardest to fill were project managers or supervisors or estimators. But in the aggregate, 86% of the firms said that a salaried position was hard to fill. Why? We gave them several choices, but overwhelmingly, the most frequent answer was that available candidates don't meet industry requirements. Either they didn't have the right skills or they had a blemish on their record that prevented them from being hired for that particular position. Not surprisingly, with that difficulty in filling positions, over 60% of the firms said that they had encountered project delays due to a shortage of workers, either their own or subcontractors. That was the #2 reason for delays, following shortage of materials or supply chain problems. Well, going forward, I don't think things are going to get better anytime soon. I have a couple of reasons to be concerned. First, the low vaccination rate among construction workers. There's an ongoing survey of Facebook users being conducted by the Delphi Group of Carnegie Mellon University. Now, admittedly, that's not a scientific sample, but nevertheless, it is now quite a long database, and the results have been consistent. The latest figure is as of October 24th. 53% of the respondents who identify themselves as construction workers say that they've been vaccinated, compared to 81% of other occupations. On the flip side, construction workers are more than twice as likely to say they're hesitant about getting vaccinated as others. So as we move toward more and more owners or the federal government or state governments mandating that people on a premises, whether it's a federal project, a hospital, or some other place, be vaccinated, I think it'll be harder for construction firms, come up with a full, healthy, qualified workforce. The other thing that concerns me is that construction has always been a good paying industry, and that's in part to make up for the admittedly tough working conditions. And this chart shows that ever since this series began in 2006 until the pandemic hit, average hourly earnings in construction exceeded those in the total private sector by anywhere from 9 to 12%. Well, once the rebound from the pandemic began, that margin shrank. It's now 7.8%. And I think the reason for that is something that you've all seen or read about, those signs in fast food windows saying $16 an hour plus signing a retention bonus, warehouses and delivery services saying stick with us for 90 days and we'll pay for your college tuition, those kinds of things. I'm not hearing about that in construction. And so at least at the lower end, that starting wage is no longer enough of an attraction to beat out jobs that have easier working conditions, perhaps more flexible hours, perhaps less potential exposure to COVID. As a result, I think contractors are still going to be struggling for quite a while to fill positions, and they're also likely to have to start raising pay much more. Well, let me switch gears to costs. And just this morning, we got new producer price indexes from the Bureau of Labor Statistics. One series in particular is called Inputs to Construction Industries. And this puts together all of the materials and services, such as lumber yards or materials wholesalers and trucking services that construction firms buy, whether for residential or non-residential construction. And you can see that that index shown by the red line has gone up an unprecedented 28% since the low point in April and May of last year. Meanwhile, what I call the bid price index, the formal name is the producer price index for new non-residential building construction, was dead flat through last year. It has started rising. In fact, took an unprecedented jump in the past month. It was up 7% in just 1 month. That's more than it has typically gone up over a 12-month period. But nevertheless, that gap between the blue and the red lines remains enormous. What's contributed to the huge jump in prices? Many things. This shows that the producer price index for steel mill products more than doubled over that 1.5 year period. Copper and brass mill shapes went up by 2/3. Aluminum mill shapes 40%, and plastics up by 1/3, gypsum products up by 1/4. Even architectural coatings have gone up by more than 15%. And so even though that bid price is now moving up considerably, it's way below the increase that we've seen in these other things. Now, there's one I didn't mention, and you can see the huge dive in lumber and plywood prices from last summer until last month. But look at the very end, it started up again. And if you go back to the September to November period of last year, you see a similar, though shorter decline, quickly followed by extreme price increases again that brought the price to record levels 2 months later and kept going until an all-time high in May of this year. I don't expect the lumber prices to get back to those crazy levels, but this does show how volatile and short-lived the prices can be, how short-lived the price cuts can be. But accelerated a little last month. They were up 1.8% just in the last month. But as you can see, that line has been rising every single month for a year now. So I think we're still going to have quite a period of price increases. In fact, how long can that gap last between price increases and bid prices? I don't have a crystal ball, but I have a rear view mirror. And what it shows is on this graph. This takes the year-over-year change in materials costs minus the year-over change in bid prices, in this case for warehouse buildings, which is the one we have the longest series for. And all of those periods in red are when the contractors were hemorrhaging profits because their costs were outrunning their bid prices. That lasted for 28 months from late 2009 to the beginning of 2012. And again, for almost 2 years straight throughout 2017 and 2018. It hasn't gone on as long this time, but you can see the peak a few months ago was more than twice as great as ever before. And that means the pain is even more intense. And certainly for subcontractors whose purchases are mainly of one of those fast increasing products, the pain is even more intense. Well, AGC can't build you a new gypsum plant or unload containers any faster, but we do try to inform owners and officials and media about what's going on. We put out 5 editions now of what we call the Construction Inflation Alert. It's an 8-page document that lays out these horrendous cost increases and supply chain bottlenecks. We also, along with 40 other associations, and forgive me, I don't remember if AWCI is one of them, we sponsor a suite of contract documents called consensus docs. One of those is a model price adjustment clause. If you can get the other party to agree to accept some of the risk of price adjustments in exchange for the reward of any price declines that come along, you may be able to reduce your contingencies. And we've done a number of webinars that focus on the ways of coping with these supply chain and cost issues. One area in which we've had very limited success is in lobbying this administration to get rid of tariffs. We did see some good news come out of the summit, the G20 summit 10 days ago, where President Biden and the EU Trade Commissioner announced an agreement to remove the tariffs on steel and aluminum coming out of the EU, but it was hedged in. They're still in place on tariffs, with tariffs on steel and aluminum from many other trading partners, and no relief yet on the tariff on Canadian softwood lumber, which certainly has pushed up those prices, or on the thousands of products coming out of China. As I said, I don't have a crystal ball, but I do look at some other folks' crystal balls. For instance, the Architecture Billings Index is put out each month by the American Institute of Architects. They ask several hundred architecture firms, were your billings higher or lower than the month before? And if the number of firms that say they were higher than say they were lower exceeds the number of say they were lower, that index is above 50. And you can see here that not only was the September index above 50 and the year ago index well below, but in fact, for 8 straight months, we've had that situation. AIA says that that indicates a demand or actual construction put in place for a new non-residential building construction 9 to 12 months out. Similarly, Dodge Data and Analytics, they go through their database of projects and look for ones that are in an initial planning stage. And what they found is that the sub-index for, well, the overall index is now at a record high, as is their sub-index for commercial construction. They also have a sub-index for institutional construction. All 3 of those indexes are well above year-ago levels and have been for almost all of this year, which indicates, they say, what will happen 12 months later. So we're coming up on that anniversary. Good sign for non-residential construction. Multifamily, the Census Bureau each month reports on single family and multifamily starts and permits, and then a figure on permits that have been drawn but not yet turned into starts. Now, developers don't always rush right into starting a project once they get the permit. Sometimes they wait until a building is leased up to a certain percentage, or if you have a garden apartment complex, they'll do one building. Let me hop back for a minute because I may have skipped over a slide I wanted to show. Okay, I guess not. Let me just go forward from here and tell you where I think things are headed. I'm not quite as optimistic as those indicators I just showed you. I do believe that economic recovery is going to continue. We had quite a pause in the 3rd quarter. Real GDP, that's Economist speak for inflation-adjusted gross domestic product, or the value of all goods and services produced in this country, net of imports. That real GDP figure went up by 2% at a seasonally adjusted annual rate, and that was down from 6.7% growth in the 2nd quarter and about the same in the 1st quarter. So we had extremely rapid recovery, really for a full year from that first shock from COVID back in early 2020. It did slow down a lot, I think, for a couple of reasons. First of all, the widespread supply chain shortages, notably for semiconductor chips, had a direct impact on auto sales, which were a significant part of GDP, but many other things were also affected by various supply chain bottlenecks. And second, the Delta variant certainly slowed down some economic activity. Travel, which had begun to bounce back, entertainment, office reopenings, all of those things were set back. But they haven't disappeared. I think that we have some pent-up demand, which will start showing up perhaps later this quarter, certainly into 2022. So I do think that the economic recovery will gather some speed. But nevertheless, we do face still more risk from the virus. We have a distressingly large share of the population that refuses to get vaccinated, and they put themselves at risk and everybody else also. And so it's quite possible that we could have another spike in hospitalizations and even deaths, and with it, a further pullback in reopenings and economic activity. And then we also have the problem that I mentioned, that construction workers seem particularly resistant to getting vaccinated. But even if none of that proves to be a problem, construction is likely to lag the rest of the economy, because so many owners, whether it was businesses that had planned to expand, investors, lenders, landlords who lost a lot of rent, institutions such as universities that have seen a near total loss of those full-pay foreign students, government agencies such as airport authorities that have not seen the return of international travelers and not a full recovery of domestic flights or travelers. All of those kinds of owners have seen a huge loss of revenue, perhaps a lot of unbudgeted expenses, and a big question about how soon, if ever, are they going to need those facilities that they would have built. So I think the recovery, as I said, will be slower for construction. Nevertheless, we've probably reached the low point and are going to see more pickup. Already, we've seen tremendous demand for warehouses. That includes the so-called last mile or last hour facilities. Some of those are standalone facilities. Some of them are conversions of abandoned big box stores or anchor stores in malls. And some of them are hybrid facilities. There's a grocery store near me that closed a couple of years ago. It reopened this fall as an Amazon Fresh store. And when I went in there, I saw that, yes, they do have some groceries you can pick up, a conventional retail store, but a big part of the space was for pickup or for delivery services. And so that's really a form of distribution facility inside a retail store. But it's not just that final step. We are seeing growth of cold storage, whether it's to deliver foods to groceries and direct to consumers, or for vaccines and medicines. And then there seems to be unending appetite for the big fulfillment centers that Amazon, Target, Costco, and other companies have been building. And in addition, we've seen huge unending demand for data centers, start of pickup for the demand for manufacturing of many types, and also restaurants have been coming back. Now that people are more willing to venture out, they're going either to restaurants that had closed down and have now built out into streeteries or put out some of their sort of outdoor addition, or new restaurants have taken the place of ones that went out of business. And then on top of the reasons that I said things would be slow, we are seeing some owners start to hesitate with these runaway costs and the supply challenges of even getting projects finished on time. So I think this is one more thing that will hold down overall non-residential construction in the near term. Now, just this past weekend, we got great news that the Congress had finally passed the Infrastructure Investment and Jobs Act. And President Biden says that he'll be signing that as soon as he can gather together the members of Congress who help push that over the top. But I don't think you should get out your paintbrushes yet. While it does have an unprecedented amount of money for many categories of infrastructure, some never getting federal funding before, that money will take varying amounts of time to actually turn into projects put in place. Yes, the state DOTs, some of them already have shovel-ready projects, ones that they're ready to award as soon as they get the go-ahead from the Federal Highway Administration. But new categories are going to take longer for the federal agencies to develop the procedures for awarding that money and publicize those rules. And for if it goes through state or local agencies, they're also going to have to go through several steps before the money flows into construction. So I think by and large, those infrastructure funds won't really hit construction before late 2022 or even later. Nevertheless, it will eventually mean a big additional demand for construction. For longer term, there are a few trends that we can discern. We've seen a huge slowdown in population growth over the last 5 years, quite apart from COVID. We had a steady decline in the birth rate, an increase in the death rate as more people moved into the oldest age brackets, but also, unfortunately, a big growth in death by suicide and by drug overdose. And those trends were all accentuated by COVID because the birth rates dropped even more sharply, hundreds of thousands of excess deaths due to COVID or to other conditions that weren't treated in time, and a huge drop in immigration. I know you might not think that from looking at the TV where you see masses at the border, but the fact is very few people are getting in these days, either illegally or through getting visas. And this is certainly going to be a hardship on construction, which has relied for decades on immigrant labor to make up more of its workforce than many other sectors. The slower population growth will continue even if we do get some rebound in each of those categories. And that means slower growth of housing, and with it the streets and underground utilities that go to new housing developments, slower growth in demand, therefore, for schools, libraries, police and fire buildings, and also for slower growth of revenue for local governments. The shift from retail to e-commerce is permanent, and it's going to keep evolving. We're already seeing distribution structures go much higher as they put in more automation, and it's starting to see more deliveries by drones or robots or autonomous vehicles, all of which will mean the less need for truck bays and parking areas. The healthcare industry is also evolving. Hospitals have had huge revenue loss from having to turn away elective surgery patients, or also people who would have come to an emergency room if they didn't have COVID and the hospital was already full of COVID patients, they were turned away. And then nursing homes also received very bad publicity from the deaths that occurred early in the pandemic. So people are turning more to emergency rooms that are outside of hospitals, to in outpatient surgical centers, and other forms of specialized care facilities and doctors' offices for care. The energy market also undergoing huge transformation, more wind and solar, offshore wind, with it the need for transmission lines, for enormous battery storage capability, and then for vehicle charging facilities. Now, none of that may affect the wall and ceiling industry, but it does trigger demand for more kinds of manufacturing plants. And so we are going to see growth in more categories of manufacturing on top of what's already been going on. We've seen a big pickup in the number of pharmaceutical plants to produce vaccines and medicines, growth coming soon, I think, in truck terminals, and also in food processing plants. Those have started to come back as the food processing companies produce more for delivery to groceries and direct to consumers, different quantities, different packaging, and so forth, compared to serving institutions and restaurants. I also think that while for now we're going to see a rebound in K through 12 construction, because we are getting more housing built at the fringes of metro areas where you may not have enough school capacity, gradually that will taper off because the birth dearth will work its way through the school population, school-age population. Well, let me close by, then I'll say there are a couple of unknowns. We don't know yet if demand for offices will come back, or we'll permanently see more companies allowing people to work remotely at least part of the time or to go to hoteling. So fewer people have a permanent dedicated office. They're sharing space, all of which would really squeeze down demand for office construction. Right now, the office market is basically limited to remodeling, and that's not so bad for the wall and ceiling industry, obviously, but it's certainly less robust than we saw going into the pandemic. Let me close by showing you where population changed last year. These are estimates that the Census Bureau puts out each December. So next month, I'm hoping we'll see figures through July 2021, although they may wait until they've worked in the decennial census numbers that were released earlier this year. At any rate, what you see here is that US population growth slowed to just 0.35%. That was less than half as fast as just 5 years earlier. And notably, there were 16 states in deep red, meaning they lost population. That was the most in the 120-year history of this series. In particular, California lost population for the first time, probably the first time since it became a state in 1850. Well, California's loss was a gain for every other state, but most of all for those intermountain states. Idaho led the country for the third year out of 4 with a growth rate of 2.1% in each of those years. That was now 6 times the US growth rate. And the year that it didn't lead, it was right behind Nevada at number 2. And you can see that besides Nevada and Arizona, Utah also in pretty bright green. Those 4 states have been in the top ranks for several years in a row. Also, Texas, Florida, South Carolina, Washington State, and interesting Delaware, the only state in the mid-Atlantic or the midsection of the country that isn't in the pink or red. Now, I don't think that's because of a boom within the state, but a lot of people from where I live in DC are building second homes or actually retiring full-time to live in the coastal area of Delaware. So special factors for each state, but the general trends are going to stay in place. Slow growth or decline throughout that upper northeast and midsection of the country, more rapid growth in the southeast, Texas, and the Intermountain states. Well, I'll close by inviting you to sign up for the Data Digest that Anne-Marie mentioned. It's my weekly one-page summary of economic news relevant to construction. And the next issue, for instance, will include a discussion of those latest producer price indexes and a link to a set of tables I update every month that shows what's happened to about 60 PPIs and other cost indexes. I'll also send you AGC's latest construction inflation alert and a copy of these slides. And I invite you to look at agc.org for lots of other information. So with that, let me stop sharing the screen, although I'd be happy to go back to anything you've seen and turn it back to you, Anne-Marie, to see if you have any questions.
You can. We do have some questions. A lot of people are asking, where do you see us getting back to pre-pandemic with specific to material pricing? So we're experiencing labor shortages, higher pricing material, which equates to higher construction costs. Is there an end in sight to this material inventory shortage?
Boy, I wish I could say there was an end in sight, but let me take the pieces of that. For each material, there's a different story. Now, for paints and for many of the plastic-based products, vinyl products, and so forth, the special factor, as you probably heard, was that giant freeze in Texas last February that damaged all of the plants that produce the resins that go into many types of plastics, including insulation, roofing materials, vapor barriers, many paints, and a lot of other things. It took those plants quite a while to get back on stream because of a shortage of nitrogen, a shortage of the specialized workers needed to fix and restart those plants. They did, eventually get back into full production. But by then, the pipeline, the metaphorical as well as the physical pipeline for plastics had emptied out. The shelves or the warehouses had really emptied out. And before they could be fully rebuilt, along came Hurricane Ida at the beginning of September that damaged plants in Louisiana. Eventually, I think these things will be worked out. We're also getting some limited capacity additions. Lumber mills, steel mills, some other sectors are adding capacity. And gradually also demand will cool off, but it's likely to be a long process. On the labor situation, I'm really concerned that that's going to last even longer because particularly for construction, for the reasons I mentioned, that hesitancy of construction workers to get vaccinated. But we really don't know how many of the people who dropped out of the labor market over the last year and a half, they've made a permanent decision not to come back. Is it because they have enough income and assets from other sources that they don't need to work? Is it because they are one of the several million people who have this somewhat ill-defined, no pun intended, series of symptoms, of varying symptoms, or recurrent or persistent symptoms known as long-haul COVID? Are they having to take care of someone who is sick or whom they can't find child care or adult daycare? Or is it because they're afraid of getting exposed, getting the disease, bringing it home to people who haven't been vaccinated? Lots of possible reasons that may keep people out of the labor force for an extended time. So all of that suggests that construction, along with many other industries, is likely to have trouble filling its workforce for quite a while. And of course, the situation is made even worse for construction by the harsh attitude we've had and the other impediments that are in place toward immigration these days.
Thank you. With the increase in material cost, does this turn into sustained wage increase? So should employers expect to pay more in salaries?
I think so, but construction has so far not done that. There are a number of series that measure pay in construction. Two of them, private sector sources that I pay a lot of attention to, have been pretty consistent. One measures union settlements, local union settlements. It's put together by the CLRC, the Construction Labor Research Council, which AGC and a number of other associations support. And their report on wage settlements up through September of this year showed no acceleration in those first year settlements compared to last year, only up about 2.8%, which was similar to what had occurred for several years in a row. And then PAS, a consulting or information business for executive and salaried pay in the construction industry, they've been reporting wage increases on the order of 3-point-some%, but again, not accelerating. And yet, when we see what's happened more broadly in the private sector, even apart from those extreme examples of a donut shop doubling its starting wages, we know that other industries are raising pay faster. And I think that means that construction firms are going to have to pay catch up, either with the starting wages and then working up through the ladder, or they're just going to be paying more in overtime to get the job done by the people they do have. So one way or another, that wage bill is going to go up. But I do think that the wage ladder itself is going to add a few rungs.
You. Couple questions here about steel and the feds. So when do you think we will have more steel mills and other materials here in the U.S. so that we're not as reliant on the other countries for these materials?
Well, we've seen very limited additions to capacity, either reopenings of the plants that had gone cold or bringing back steel workers so that they're able to produce closer to full capacity, and some additions to building of new mini mills or rolling mills. But we're still going to need foreign steel. The price of foreign steel is so much lower than domestic steel that we would really benefit as a steel using sector if those tariffs came off completely. It would not wipe out demand for U.S. steel by any means, but I think would make those prices easier to swallow. I do watch the steel market update survey of several hundred steel industry participants, and they put out a hot rolled coil price, and that peaked at $1,955 per ton just after Labor Day. It's come down every week or biweekly since then, but it's still around 1,800. So several multiples of where it was before COVID hit. And I think the expectation among the people they survey is turning more toward quicker delivery times and also more or less for falling prices, although there certainly isn't consensus about that the way there was on the upside for so many months. So I guess my own forecast would be expect volatility. I've certainly been getting dear valued customer letters from our members, and if any of you want to send me those, I'd appreciate it. They keep me ahead of what I see in the producer price indexes. At any rate, there are certainly some steel products that are still going up in price. There's still some incredibly long lead times. I'm getting things like bar joists or roofing fasteners and so forth. But I think we've probably hit the worst of it for some types of steel, and others are going to actually improve in the near future.
With the Fed's funds rate so low, what other macroeconomic forces, efforts do you foresee as potentially available to reduce inflation?
It's really something I'd like to see the market be able to fix. I worry when government shows up to help. There certainly are some things. I mentioned tariffs. That is the most direct help because it immediately undercuts the price that domestic producers are charging, or it opens up more supply. Second, there are some regulatory things around transportation. A century now, we've saddled ourselves with the Jones Act, which requires that goods moving from one U.S. port to another have to be carried in U.S.-built ships and staffed by U.S. crews. And those are far more expensive and sometimes less available than foreign-built ships, let alone with foreign crews. And we also have various regulations at the ports themselves, most notably in California. President Biden himself got involved in ordering 24-hour, 7-day-a-week operations there, but that doesn't cure the market. It doesn't mean that the truck drivers will magically start appearing at all hours if they don't see that they can make money doing so, or if they can't get the chassis to carry the containers away. So there's...
Sorry, Ken, I think we lost a connection there for a second.
Okay. Yeah, I was wondering about that. What was the last thing that you were able to hear me say?
Talking about the chassis and Long Beach.
Right. Okay. Well, if you had a question after that, I did not hear it. So
okay, here we go. Lumber prices seem to be coming down. Will those lumber prices keep dropping and get back to pre-pandemic?
Well, you're right that my chart showed that the producer price index for lumber, which measures the price at the producer level, the mill level, that had a dramatic drop. It reversed slightly last month. I see that the PPI for lumber and plywood went up 3.2% from September to October. That's a mild version of what was actually happening in the futures market. That you can see every day on the CME, the former Chicago Mercantile Exchange, the price of 1,000 board feet of lumber, and that jumped from, well, it hit a peak of something like $1,700, just 5 times what it had ever been before, dropped back down all the way to the 400 and some range, and then it got up into the 600, even $700 range briefly. So extremely volatile. Now it's back down around $500 to $600. So again, it's down, but not to where it was 8 weeks ago. And so I'm not confident that we'll continue to see prices drop at the lumberyard level or the home improvement store level. There's not a direct connection because lumber does move through several steps. So the futures price is kind of a signal to all of the market players what the expectation is from the financial markets. But each mill is looking at its own supply and demand, as is each distributor and ultimately each retailer. But for me, the takeaway is expect prices to continue to move, sometimes dramatically in both directions. But as long as housing demand is staying high, and I certainly see that remaining very high for quite a while. Yes, we've had a big, huge increase in house prices nationwide, by some measures up 13 or even 18% on a year-over-year basis. Nevertheless, there's still a lot of pent-up demand because we basically underbuilt housing for almost a decade. And now we have a lot more people who have a lot more income, a lot more wealth from capital gains or from having an existing home that has appreciated. So I do think we'll still see a lot of single family and also multifamily construction. Back in the previous peak, 2001 to 2006, single family was basically pulling people out of multifamily, but now we're seeing more demand for both. So all of that suggests very strong continuing demand for lumber. And I don't think prices will get back down to pre-pandemic levels. Now, again, getting rid of that tariff on Canadian softwood lumber would help. But unfortunately, the Commerce Department earlier this year did a calculation that the tariff that's currently 9% should be more than doubled, 18.3%. The administration says that it's going to engage with Canada in negotiations, and hopefully they'll get Canada to give up something they want in exchange for foregoing that tariff increase. But if those negotiations break down, we will see even higher tariffs on Canadian lumber and therefore even higher prices on U.S. lumber.
Thank you. Two final questions. So one is asking, do you see projects stalling or getting placed on hold because they do not make financial sense at this time?
I've been surprised how many projects have gone ahead or how few have been put on hold, both because of rising costs, but also delays and then demand destruction in some categories. But I think because the U.S. economy is basically healthy, we added over 500,000 jobs last month. We are continuing to get growth in real GDP, huge demand for housing, for manufacturing facilities, for distribution facilities, and so forth, that I think that we'll continue to see strong demand for many kinds of construction materials and also continuing price increases for projects that owners will be willing to accept by and large. Obviously, there will be some cases where projects no longer pencil out because they won't be able to charge the rents or what other kind of revenue is supporting the project. They may not be able to sell enough of whatever they were going to use that project for. But by and large, I think we will continue to see growth in non-residential construction and relatively few project cancellations. There may always be some value engineering or trying to squeeze costs out, some projects deferred when owners realize they can't open that store by Thanksgiving or they can't have that school open by next August. But nevertheless, for the most part, I'm pretty optimistic.
Thank you. Final question here is about light gauge steel, so raw material, hot and cold forms. They seem to have increased more than doubled, but showing signs of prices coming down are positive. Will this provide more certainty to the developers to continue with their projects? And And then also, do you know which states seem to be using more light gauge steel?
I don't have figures on the geographic distribution of light gauge steel. I've certainly heard many discussions over the past year about substituting one product, one method of construction for another, but generally it's a case of jumping from that wood fire into the steel frying pan, that nothing was available or cheap enough to warrant making that switch. So whatever material you've been using, chances are folks are going to continue to spec. As for light gauge steel in particular, I don't have a feel for how that market is going to firm up compared to other kinds of steel. But as we've seen, there are big differences in both how availability changes and how prices change for one kind of steel or another. They do move through different production channels. So it really depends on how much supply, how much competition there is in one set of mills, of steel service centers, or of fabricators, whatever process for getting that steel.
All right. Well, thank you. That was the last and final question. So on behalf of AWCI and the foundation, I would like to thank Ken Simonson and all of our attendees in joining us for today's webinar. And thank you to the Foundation of the Wall and Ceiling Industry for sponsoring our webinar. So thanks again. Have a productive day, everyone. And Ken, safe travels to you. Take care. Bye-bye.
Thank you. Bye-bye.